Welcome everyone. It's David here with NavFile. Today we're just gonna go over the Walt Disney Company's fourth quarter earnings, my financial analysis of the quarter. I've been doing this since 2019. However, this is the first video I'm doing on this to cover that. So it'll be a brief video, just going over the highlights of the quarter, what's going on with the company, what to look for going forward. Those type of things. Basically, I'll be going over my presentation that I have on the NavFile site with my article. You can check it out there on the website. It's under NavFile Center, which I do these quarterly, usually a little bit after the quarter, after I can take a look at everything, see how the company's doing. So let's first get started with these slides in the presentation here. So yeah, you can go to the NavFile website, read my article, try to go into most of the big areas for the company's quarter and that. So you can go on there, take a look, read the article. This video that I'm doing right now, though, will just give you pretty much a quick overview of everything and that. So yeah, so in this presentation that you can also grab on the NavFile site in that article, we'll just have pretty much a performance review and a review of each segment of the company, the cash flows, which is usually very important for companies, and what to watch for going forward. So we'll get started on that. Start off just an overview of the earnings for the company. Walt Disney Company reported earnings per share that was a loss of 39 cents. Net income was negative $710 million for the quarter. Comparable EPS, which is excludes certain items for comparability to last year's quarter, was down, and it was they reported a loss of 20 cents per share. That's actually the first comparable EPS loss of the year in this fiscal year. So however, the company did beat estimates of 71 cents per share, the loss of 71 cents per share, which was 71% lower what they actually reported for comparable EPS than expectations. And revenues were slightly below expectations, but pretty much in line. Now we're gonna, pretty much our overview of the earnings. Some really the big key areas for that. COVID-19 is currently affecting the company still, and probably will be for a while. First quarter for comparable EPS loss and regular EPS loss. So the first time that happened this year. Segment operating income was down 82%, which is a pretty big drop. And company's now clearly pivoted heavily towards direct-to-consumer, and with the investor day that just occurred, not too long ago on the 10th, Disney's making a big move into that with content. So that's really seems to be the strong focus going forward, which maybe a sign that the company is not seeing that the parks going to be returning to even at maybe 50% capacity at certain places soon. So they're really putting more focus on the at-home plays and that. So Disney Plus did reach 73 million subscribers at the end of the quarter, which was a big. And by the Investor Day presentation, they had 86.8 million subscribers, which is a really good growth on that side. Parks, experience products is the segment that's having the biggest hit, and they had an operating loss of over $1 billion, and the impact from COVID-19 was about $204 billion according to the company. As everyone's probably familiar with, Disneyland California Pier is still closed, and it's really unknown when they're going to be able to reopen those parks, which is still a big impact for that segment. Studio entertainment had more impacts from the COVID-19 situation. There were no new films. Movie theaters were closed. The operating income was down 61% for that segment. And media networks, which has done pretty well for the company so far during this COVID-19 cycle right now, revenues were up 11, and income was up 5% for that. We'll go more in detail on when we get to the segment. Each segment section there on that, and that. So direct to consumer, had a good quarter also. Revenues were up 41%, and operating losses decreased by 23%. And overall, for the direct consumer offerings, they have 137 million subscribers as of December 10th, which is after the quarter, but reported on the Investor Day presentation there. And overall, $3.1 billion hit due to COVID-19 across the whole company, which is a really big hit. Company though, it's kind of stabilized its operations pretty much. However, operating losses, something to look see if that can be at least addressed here in the next couple quarters. However, we'll have to see how that goes. Really, they're going to be heavily investing in direct to consumer, which is a big growth area for the company. Okay, so now we'll head into take a look at park experiences product segment real quick. Pretty much went over a lot of the pretty much the hit that segment's taken. Revenues were down 61% compared to last year. Income's down over 180% if you want to use that with negative numbers, because they lost about 1.1 billion this quarter, and last year's Q4 they made about 2.6 billion on that. So really, that the segment's gonna be not too sure what's going to happen operational wise going into next year. So the company is not able to open Disneyland California, and Disneyland Paris remains closed. And it's unknown when those are going to be able to reopen at any capacity. Walt Disney World is at 35% capacity right now, and it's doing okay there. It seems like I was looking at some of the availability for booking days at the park. It seems like it's okay. So I know Christmas Day is still available for Magic Kingdom and all the other parks, including New Year's Day. So that's maybe a little bit of somewhat of a downside there, looking at that after the quarter. Moving on to studio entertainment. This one's probably the second most hit segment for the company with the COVID-19 situation. Movie theaters are mostly still closed, or most people are not going to the movies still, even if they're open. So that was companies impacted by that. They did not have any new movie releases again during this quarter. Revenues down 52%, and operating income decreased 61%. So still large declines there, and pretty much have to see how they can pivot that with direct to consumer, and using direct to consumer to kind of distribute their films and that, while the movie theaters are still impacted. And going on to media networks, which is the company's best performing segment financially this year. Revenues were up 11%, and operating income was down 5%. Was up 5%. Our cable networks had an income down 7%, with revenues up 11%. ESPN was pretty much the factor behind the declines at cable networks. Higher programming costs for ESPN due to mostly MLB and NBA rescheduled games into the fourth quarter. So that affected ESPN there. However, FX networks and Disney Channel's domestic side were up. FX up on lower programming costs. Disney channels were up on sale content to Disney Plus, so another positive thing from direct consumer there. Broadcasting was pretty much the big winner for media networks, which had operating income up 47%, with revenues up 10%. So they had lower programming costs and increased affiliate revenue were behind those moves there. However, both the cable networks and broadcasting had lower subscribers and viewership. So that's a continued trend that's going on in media networks, which companies, I believe, is trying to at least minimize with direct to consumer. So, and that's where we head to next. Review direct to consumer here and international. revenues increased 41%, while operating losses were down by 23% compared to last year's quarter. Yeah, as mentioned before, Disney Plus had over 73 million subscribers, and Hulu and ESPN Plus were good performance drivers for the segment this quarter. Both had an increase in subscribers. ESPN Plus had more success with UFC sales there, so that was good for that. And there's 137 million subscribers for all of its services as of December 10th. And international channels were down due to pretty much lower ad and affiliate revenue there. Not too much mentioned about what's going on there. However, Investor Day company is using direct consumer to enter those international markets through Star. So that'll be another big thing to watch there. And on to the cash flows for the company. The cash flows were cash provided by operations pretty much was $1.667 billion, which is down 3% from last year. Investments, parks, resorts, and other property was $508 million, which is down from last year. Free cash flow was $938 million, which is up 44% from last year's number, which is pretty much due to the lower investment in parks and resorts there. So Disney's still getting more cash coming in for there. Still at a good pace. So, going forward, taking a look at what to watch, pretty much parks and resorts, I think it's still number one. It has, continued losses for the next year. How long is that going to continue? That's going to be big. However, close number two, maybe still number one, direct consumer growth is going to be big. And that's where the company's really focused on right now. And with the big content push that they've announced at an Investor Day, it's going to be interesting to see how fast that's going to grow even more subscriber wise. So, if the company's able to grow that pretty well, it's added like a Netflix subsidiary to the company, which Disney could be, valued differently than it's used to. And it's, traditionally have been valued at. So that's something to watch, which seems to be happening in the market right now. And then I think I talked a little bit about studio entertainment and will it be helped by DTC? That's going to be an interesting, type of situation there if they can use direct consumer to help to stabilize studio entertainment. And back to parks and resort, is Disneyland going to open? Right now, it does not look like it's going to open anytime soon. So company's going to have to operate without that, and I'm not too sure about Paris either. So that's pretty much what to watch for there, and how the company can minimize any continued losses from that segment of the company. But at-home plays are going to keep moving the firm forward. So that's pretty much what seems like the company's going to be focusing on. So that's what I watch for going forward. So pretty much going over the first quarter with a comparable EPS loss, which is pretty tough. But however, company beat expectations, which was good. Direct to consumer was looking really good, and pretty much what they have planned for that, it's real nice. So that's something pretty much to keep an eye on, and the company will be really talking about that a lot. So yeah, but just pretty much the parks can start moving up even more next year. That'd be good, and just keep moving forward. I think that's what the company's doing. So they're at least continue to working on what's working for them, and that's turned out pretty decent compared to what's happened in this fiscal year for the company, which is a really tough year for the company. So pretty much just look forward to see how the company can recover still from this year of 2020. So I just want to thank you for tuning in tonight. This is technically my first video for NavFile, and my first video that's going to be out there on all the platforms. Wherever you're watching, there's a link to our article, usually in the description or comments. I just want to thank you for tuning in. Hopefully you got some information that about Disney, which is an interesting company to cover, which I like to cover, because it's really got something for everyone that I think everyone would like. So that's it, and thanks again for tuning in. I will see you in the next quarter and probably some other videos. So bye for now.